Hey everyone, welcome back to Corporate Decoder, the place where we sift through the confusing jargon of corporate filings to find the real money story. Today we're diving into PROG Holdings' latest quarterly report, and let me tell you, there are some interesting numbers in here that paint a pretty clear picture of where they're heading, a picture that might just have a few unexpected twists. So PROG Holdings is a financial tech company that basically offers lease-to-own solutions through its brand Progressive Leasing, and also provides credit products through V Financial. Think of them as helping people who might not get traditional loans get the stuff they want. Now let's get straight to the numbers because that's where the real juice is. Looking at their balance sheet for June 30, 2025, total assets stood at about $1.45 billion. That's a bit down from the end of last year when it was just over 1.5 billion. This slight decrease isn't a red flag all on its own, but it's worth keeping an eye on as we dig deeper into what's driving this change, specifically in their lease merchandise, which is a big part of their business. Speaking of lease merchandise, that number dropped significantly from around $680 million at the end of 2024 to about $524 to about $526 million in mid-2025. This is a big chunk of change and signals that they're perhaps selling off more inventory or not buying as much new stuff. Combined with a softer GMV in their progressive leasing segment, it suggests a slowdown in that part of their business. Now let's talk about their earnings. For the second quarter of 2025, revenue was up slightly to about $605 million compared to $592 million in the same quarter last year. That sounds good. But here's where it gets really interesting. While their lease revenue stayed pretty much the same, their interest and fees on loans receivable, which comes from their Vive segment and other operations, jumped by a massive 61% to nearly $35 million. This is a really strong performance from their credit side of the business. However, keep in mind that while their lease revenues were flat, their provision for lease merchandise write-offs, which is basically their estimate for lost or unrecoverable merchandise, also decreased. This decrease in write-offs is partly due to a tighter decisioning process they've put in place, which is smart, but it could also mean fewer people are qualifying for their lease programs. Operating expenses saw a noticeable jump up by about $8 million or 7.7%. A big part of this increase came from professional services and computer software expenses. They're investing more in technology and potentially dealing with more legal or advisory fees, which could be related to market conditions or their business strategy. On the flip side, their provision for loan losses also increased by over $5 million. This is expected given the growth in their loan business, but it shows they're anticipating more potential defaults as they expand in that area. Putting it all together, earnings before income taxes increased to about $52.6 million from $48.3 million in the prior year. So despite higher expenses and provisions, the growth in their credit business and some cost savings like lower restructuring expenses helped boost their bottom line for the quarter. Now let's look at the first half of the year combined. Total revenues jumped pretty much across the board to around $1.29 billion, up from $1.23 billion last year. That's a solid 4.4% increase. Lease revenues from Progressive Leasing were up by about $30 million, largely because they started the year with a bigger lease portfolio. But again, the star of the show is the interest and fees on loans receivable, which surged by a huge 57%. This really highlights a strategic shift, or at least a very successful execution in their credit lending operations. The story with operating expenses for the first half mirrors the quarterly trend with a slight increase overall, but one massive change is the restructuring expense, which went from about $29 million last year down to $0 this year. This is a big positive as restructuring costs can really eat into profits. The provision for loan losses also increased significantly by nearly $8.7 million. This is an important number to watch as it directly impacts profitability and suggests they are being more conservative with their credit underwriting, which is prudent. As a result of all this, their operating profit for the first half of 2025 significantly improved, reaching over $115.5 million in the same period last year. That's a healthy 22.6% jump. And translating that into earnings before taxes, that's up a strong 24.9% to just under $100 million for the first half of the year. Looking at cash flow, operating activities were strong, providing nearly $280 million in cash, up from about $191 million last year. A big reason for this improvement was a significant decrease in cash paid for lease merchandise, which freed up a lot of cash. However, their investing activities show a larger outflow of cash, mainly because they invested more heavily in loans receivable for Viv and 4. This supports the narrative of growth in their credit business, but it also means they're tying up more capital there. In financing activities, they used over $118 million this year compared to around $78 million last year. This increase was significantly driven by paying down debt on their revolving credit facility and continued share repurchases. They actually repurchased about 1.8 million shares for over $51 million in the first half of 2020-25. This shows a commitment to returning value to shareholders. They also continued to pay dividends with about $10.5 million dispersed. So they're balancing growth investment with shareholder returns. Now let's talk customers. Progressive Leasing saw a slight decrease in active customers going from 844,000 to 802,000. This aligns with the tighter decisioning and the bankruptcy of a major partner, Big Lots. On the other hand, Vive and their other segments, which includes Four, saw significant customer growth, Vive up to 93,000 and other, over doubling to 271,000 customers. This is a clear indicator that their credit offerings are resonating and gaining traction. PROG Holdings seems to be strategically navigating a challenging economic landscape. Their lease-to-own business, Progressive Leasing, is showing stability despite headwinds, but the real growth engine here seems to be their credit segment, Vive, and the newer ventures like Four. They are successfully expanding their customer base in these higher margin areas. The increased provision for loan losses and higher professional services spending are signs of mindful growth and necessary investments. While the decrease in lease merchandise is notable, it's likely a deliberate move to focus resources on the more profitable lending operations. The company appears to be successfully repositioning itself to capitalize on the demand for alternative credit solutions. The key for them will be managing the credit risk associated with this growth and continuing to innovate in the financial technology space. Alright, that's our deep dive into PROG Holdings' latest financial report. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives like this. And don't forget to join our Discord community linked in the description below for more exclusive content and discussions. Thanks for watching. See you next time.